The checking account, you wake up. You check your phone. Your balance is $247. You've got rent due Friday, a car payment Monday, and your direct deposit hits Thursday. You do the math in your head for the third time this week, hoping somehow the numbers changed overnight. They didn't. That's what a checking account actually is. Not a place to grow money, a place to move it. In, out, in, out. It's designed for spending, not saving. The average American keeps around $8,000 in their bank accounts total. But here's the part nobody mentions: the national average interest rate on a regular checking account is 0.07%. You have $8,000 sitting there, the bank pays you $5 a year, then turns around and lends your money out at 20% interest, and it gets worse. If your balance dips below zero, even by a dollar, even by accident, most traditional banks charge you an overdraft fee. The average in 2026 is $26.77 per incident. Chase collected over $1 billion in overdraft fees in 2024 alone. $1 billion from people whose accounts went negative by a few dollars. Banks like Capital One, Ally, and Chime now charge zero overdraft fees. If your bank is still charging you $34 every time you overdraw by accident, you're not banking with an institution that's working for you. The checking account isn't your financial foundation, it's your bank's funding source, the savings account. You were probably told at some point, put money aside, save for a rainy day. So you opened a savings account, you moved some money in, and you felt responsible, maybe even proud. Then you checked the interest after a year and saw $11. The national average interest rate on a traditional savings account right now is 0.38%. Not 38%, 0.38. On a $10,000 balance, that's 38 a year. Meanwhile, inflation has been running at roughly 3% annually, which means the purchasing power of that $10,000 quietly shrank by around $300 while you were earning 38 times. You didn't grow your money. You lost ground while feeling like you were winning. And the uncomfortable part is that the bank knew. Traditional savings accounts aren't designed to build wealth. They're designed to hold deposits cheaply while the bank deploys that money at far higher returns. The median American under 35 has just $5,400 in their bank accounts. Those who have money in accounts earning 0.38% have been unknowingly volunteering their savings as raw material for someone else's profit. The savings account isn't a wealth-building tool. It's a psychological comfort with a terrible price tag, and for most people, there's a significantly better version of the exact same thing sitting one browser tab away: the high-yield savings account. Here's the thing nobody tells you when you open that 0.38% savings account: the exact same product, federally insured, just as accessible, just as simple to open, exists at a different institution offering 4.21% right now. Not a scam, not a catch, not a complex investment, just a different bank, usually online with lower overhead costs and higher rates, passed directly to you on $10,000. That's the difference between $38 a year and $421 a year. On $30,000, that gap is nearly $1,200 annually. On $50,000, it's close to $2,000 every single year simply because of which account you chose. That money doesn't require you to take on any risk. It doesn't require you to invest in anything. It just requires you to move your savings to a different account. The reason most people haven't done this isn't because they investigated it and decided against it. It's because nobody ever pointed them at it. Banks with low rates don't advertise high-yield alternatives. The account exists at institutions like Marcus, Ally, SoFi, and dozens of others. Some require no minimum balance. Some take 10 minutes to open online. The interest compounds monthly. The high-yield savings account is one of the simplest financial upgrades that exists. The only thing standing between most people and 10 times more interest on their savings is knowing it's there. The joint account, you move in together. You split bills. Someone suggests a joint account, easier to manage shared expenses. One place for rent and groceries and utilities. It sounds practical. It probably is. But here's what that conversation almost never includes. In a joint account, both account holders have equal and complete access to every dollar, not half each. All of it. Either person can walk into any branch or open any app and withdraw the entire balance without the other person's permission, without notification, without any mechanism to stop them. There's no legal structure inside the account itself that recognizes whose money is whose. Both names on the account means both people own all of it simultaneously at all times. About 54% of Americans say a partner's debt is a major reason they'd consider ending a relationship. And when relationships end, the joint account is almost always where the first financial conflict happens, because whoever moves first gets everything. Legally, the other person has no immediate recourse. Financial disputes are among the top 3 causes of divorce across the United States, and accounts that felt like a practical convenience during the relationship often become the opening move in an ugly exit. A joint account works perfectly when trust is complete and permanent. So the question worth asking before you open one is whether you're certain enough of that to put your entire financial life behind a door with 2 keys. A joint account is a financial merger. Treat it like one. The offshore account. Most people hear offshore account and picture a villain in a movie moving money through the Cayman Islands. The reality is considerably less dramatic and considerably more legal. An offshore account is simply a bank account held in a country other than your own. Switzerland, Singapore, and the UAE are popular destinations not because of secrecy, but because of currency diversification, political stability, and asset protection laws that differ from those in your home country. If you hold savings in only one currency and that currency weakens significantly, something that has happened to multiple major currencies throughout history, an offshore account in a different currency provides a real financial cushion that a domestic account simply can't. And if you're American, you have to report them to the IRS every year. It's called an FBAR, Foreign Bank Account Report. It's not optional, it's not a gray area. Failure to file carries penalties that can reach $10,000 per violation, even if the omission was unintentional. The account is legal, the secrecy is not. They're also not for most people. Minimum balances typically start at $10,000 for basic international accounts and climb to $100,000 or more at private banking institutions. The administrative overhead is real. The reporting is annual. The benefit has to outweigh both. The offshore account isn't a loophole. It's a specific tool for a specific situation, and knowing what it actually is matters more than what movies say it is. The money market account, it sounds technical. It isn't. A money market account is essentially a savings account that got an upgrade. And most people who would genuinely benefit from one have never been told it exists. Here's what makes it different. A money market account typically pays a higher interest rate than a traditional savings account. Many are currently sitting between 3 and 4% APY, with some offering as high as 4% at competitive institutions. But unlike a standard savings account, a money market account also gives you the ability to write checks directly from the account, and at many banks, use a debit card. You get the interest of a savings product with the access of a checking product. There's usually a minimum balance requirement, often $1,000 to $2,500 to avoid monthly fees, and some accounts limit the number of withdrawals per month. But if you're holding cash that you don't need immediately and don't want locked away, a money market account sits in a useful middle position. A house down payment you're building toward, a business reserve fund, an emergency cushion large enough that it should be earning something real while you keep it accessible. It doesn't require you to take any risk. It doesn't require you to understand investing. It just requires you to know it's an option. It's not exciting. It's not supposed to be. It's supposed to make your idle money slightly less idle. And on a balance of $25,000, the difference between 0.38% and 4% is nearly $900 a year. The certificate of deposit, you have $15,000. You don't need it for 12 months. You want it to be safe. You want it to earn more than a savings account. And you're willing to make one promise to the bank. You won't touch it for that period. That's a CD, a certificate of deposit. You lock your money in for a fixed term, 3 months, 6 months, 1 year, 5 years, and the bank locks in your rate from day one. Whatever they promised you when you opened it, that's exactly what you get when it matures. No surprises, no changes. Right now, the best 1-year CD rates are sitting at 4.5% APY. The rate doesn't move. That's the whole point. Compare that to a high-yield savings account, where the rate is variable and can drop at any time without warning. A CD removes that uncertainty entirely. You know exactly what you're going to earn before you even start. For someone with a specific financial goal and a specific timeline, saving for a car in 12 months, building a down payment over 2 years, that certainty has real value. The catch is real. If you need that money before the term ends, the early withdrawal penalty can wipe out months of earned interest in seconds. Some banks charge 90 days of interest for early withdrawal on a 1-year CD. Some charge 150. You find out when it's already too late to change your mind. A CD is a commitment. The rate is the reward for keeping it. The trust account, most people associate trusts with old money, wealthy families, estate lawyers in oak-paneled offices with leather chairs and mahogany desks, something that applies to other people, people with significantly more money, significantly more complexity, significantly more to protect. That assumption is why 67% of Americans currently have no will and no trust, and why many of them will inadvertently hand the government the authority to decide what happens to their money when they can't. A trust account is simply a bank account held in the name of a legal structure, the trust rather than in your own name directly. You create the trust as a legal entity, you fund the account, you name the people who will receive it, and you set the conditions under which they receive it. Simple or complex, a trust account does one thing a regular bank account cannot. It bypasses probate entirely. When you die with a regular bank account, that money enters a court-supervised process called probate before your family can access a single dollar. In some states, that process takes 6 months. In others, it takes years. The legal fees come directly out of the estate. The delays are real, and they arrive at exactly the moment your family is least equipped to deal with them. A trust account passes directly to whoever you named, outside of court, often within days of a death certificate being filed. No judge, no waiting, no percentage lost to legal fees. A trust account isn't a luxury, it's a decision about who controls your money when you no longer can. And whether you make that decision now or leave it to a system that doesn't know your family, your intentions, or your life. 8 accounts, 1 financial life. And here's the part that actually matters. None of them are complicated. What makes them feel complicated is that they were never laid out next to each other and explained in plain language. The checking account moves money. The savings account holds it. The high-yield account holds it better. The money market account holds it with more access. The CD locks it in for a fixed return. The joint account shares it. The offshore account protects it across borders. The trust account controls where it goes after you're gone. The question was never whether these accounts existed. It was whether you knew to look for them.